Imagine losing both your parents in the same year and then being handed a tax bill of over $650,000. Now, some of you have already likely seen the story of Jackie and Michael Galea of Burlington, Ontario that CTV did. And I would guess you left with the same three questions and thoughts that Shaun and I did. Number one, what a tragic situation. Personally, I can't imagine losing both my parents in the same year. But number two, what were the details and why were they hit with such a high tax bill? Number three, how are estates typically taxed? And what are some strategies to avoid ending up in the same situation? Now, I'll be honest, I think CTV kind of missed the mark here. It was subtly implied that there might be an issue with RSPs, but after looking at the details, I think it was clearly a planning problem. So Shaun, why don't you take us through, firstly, some of the details to the story, and then get into the planning opportunities at the end so you don't fall in the same trap?
Yeah, sure, Josh. I mean, like you said, it's a really tragic situation for the family to go through, and it's unfortunate for them, but it is a great object lesson for some really important principles to keep in mind when we look at our overall financial planning or retirement planning, and specifically our estate planning. So I agree. The RSP accounts or RIF accounts often get maligned as being really poor vehicles. And so it was kind of implied in how this story was rolled out. It's kind of like what we hear often when we talk to people where RSPs aren't great. You shouldn't put money in them because you're creating this major tax liability down the road. And it's kind of like these old wives' tales where they seep into the zeitgeist of planning, and yet they're not true for the vast majority of people. People get a higher tax deduction while they're working and usually are paying less tax when they retire, particularly with income splitting rules that are available to people. So this is kind of one of those things as well. All of a sudden there's this tax bomb. And what I would say before I get into the details is what was really tragic about this, like you said, was, mom and dad passed away within a very short period of time together. And that is the worst case scenario when it comes to estate planning. Now, in saying that, what are some things that we can kind of glean from this story? So first of all, the importance of planning. I know that many of us are reluctant probably to go out and seek professional advice. Certainly, we want to, keep our money and use it for other things, but sitting down with a financial planner, a tax person, a lawyer on critical issues around planning, I think is well worth the effort because it can help you plan in advance of potential tax bombs that might happen. And so a good example here in this story was they had made, a determination that they would, use the cottage as their principal residence. And they did that partially, obviously, to shelter tax. But it looks like they didn't really seek counsel about how to properly paper that from a tax standpoint. And as a consequence, there was this outstanding tax liability that the family was surprised to hear about for the property that became their principal residence. And so they had the cottage property, which typically grows and builds up a tax liability. You've got your principal residence. And it's common for people to sort of make changes to principal residences, but they need to keep in mind that there is a calculation that you need to go through because some of the deferred price appreciation on the cottage property that wasn't a principal residence will have some tax costs attached to it. And so it's not a clean break. It's not a toggle switch. You can't all of a sudden, obviously, say the cottage is my principal residence and dodge the tax. So that unfortunate circumstance likely could have been averted had some professional advice been sought during that transaction decision. The second piece that really kind of screams out is not just the importance of seeking advice, but also the importance of having the family do some proactive planning. And we'll talk about some of the proactive planning steps in this video. But really just talking through as a family, what are the goals? What do you want to see happen in terms of estate distribution down the road? Are there some proactive things we can begin doing? And I don't know for sure with this family, but it's very common for mom and dad, and particularly mom and dad in their 60s, to probably not share as transparently as maybe they should about their financial planning, their estate aspirations. Sometimes because the kids don't want to engage in the conversation. Mom and dad don't talk like that. You're young, you got lots of years ahead of you. So it stops the conversation. And mom and dad want to have the conversation because maybe they know there's some important planning issues. So having the family on the same page, being proactive with planning, understanding at a high level how taxation takes place with estates, and get professional advisors involved, particularly for mission critical transactions like, treating the cottage as a principal residence. Those are the kind of the preliminary musings. And then we'll talk about some of the planning strategies that flow out of that.
Yeah, your cottage is an extremely common tax problem that so many people in Canada, really anywhere, are going to be experiencing.
Yeah.
So the logical next question I think that we should all be asking is, how are estates taxed? How can we understand how our own estate might be taxed in the future?
Yeah. So what I did is we could use snap projections as one example, but when the story came up, I went through some slides for an estate planning course that we put together a number of years ago. And there was one particular slide that I thought I would just have on the screen. I'll go through it. I think it's a great way of just talking about the different assets that can come into the estate and then how the tax consequences flow from those assets. So the first thing that I want to share with you is just a general outline about taxes on death. We'll just go through each of these points, and then I'm going to look at a balance sheet for a client to go through it. So technically, there's no estate tax in Canada, but there are capital gains taxes and other sundry taxes that can apply. So at the time of death, all your assets are deemed to be sold, and that is a big one, right? So that can create some triggering events for capital gains. Final tax return must be filed, and capital gains tax is payable on gains from stocks, potentially bonds, real estate for investment or recreational property, like this example, and that excludes your principal residence. So this is where the family got into a little bit of a pickle because they sort of applied this toggle switch principle. Okay, now the cottage is our principal residence. Down the road, there won't be any capital gains issues. And they didn't apply the formula that's appropriate or didn't seek any tax advice at that point. This tax can be deferred by transferring assets to your spouse. So again, if you have a relationship, common law, a marital relationship, upon death, all taxes can be deferred to the surviving spouse. So if I've got property that has a realized capital gain attached to it, potentially, that gain can be deferred. So it just defers to the surviving spouse, and it's not triggered until the spouse passes away. That would be the same for investments that have deferred capital gains attached to them. And it also applies to things like tax deferred accounts. So your RIF accounts, your RRSP accounts, there'd be no tax triggered upon the first to die, it's deferred. And then on the second to die, that's when the tax is triggered. One interesting thing about taxation in the year of death tax file, it does present an opportunity for significant gifting. There is no limit in the year of death tax filing on what you can give to a registered charity. And for some families, that could be a really great way of, keeping CRA out of the situation, gifting to a charity that might be important to them, and, making sure that the taxes are reduced significantly. Okay, that's a bit of an overview. Let's just take a look at the balance sheet that I talked about in the presentation. So what you see here is an example of a balance sheet, and it's really important for clients to do an update to their balance sheet on a regular basis, not just because they should be tracking how they're, doing in terms of overall growth of their investments and property, but also it's a good piece of paper to have for family to know where things are at. So this balance sheet, you can see we've got non-registered investments right here on the top left-hand section of the balance sheet. We've got Ted and Julie assets in each of their names, and then their joint accounts. Now, I'm not going to talk in any detail around joint registration and the difference between the operation of law with estate distribution and, things like wills that are drafted for clients. That's for a separate discussion. Let's just focus on the tax treatment. So these non-registered investments, if you look at the GICs, GIC investments are typically tax paid. You're paying every year. There's no unrealized gains. So that's basically tax paid capital that either goes to the surviving spouse, but on a second to die, like the situation that we're talking about, there'd be no tax triggered on the GIC. They have a couple of portfolio assets. So these non-registered assets here, $125,000, $323,000, there were some deferred capital gains on those assets. So in the second to die, the difference between the market value at the time that the statement was produced and the book value, which is used to calculate the capital gain, that gets put in place. 50% of the gains will be taxable, and that will trigger a capital gain. Okay, let's go down to the registered assets. So they've got these RSP assets, and these RSPs, the LIRA, right here, we've got the RSP of $225,000, another RSP of $80,000. Okay, so those RSP accounts, as we know from the story, have this deferred tax liability. So that comes in as essentially income. So this, well over $300,000 of assets from their registered accounts that will come in as income, and I'll come back to that. So in the second to die, that's treated as regular income. There is a big tax bill attached to that. TFSA accounts, and you can tell this is a while ago because there wasn't a lot of money in the TFSA accounts, but the TFSA accounts, there's no tax triggered upon death. And then we have lifestyle assets, and this is the issue that got this particular family in a bit of a pickle You have the cottage property here for this family, $215,000, and we have a home that's jointly registered. Now, what's interesting in this particular balance sheet, the cottage was in Julie's name. That could create some issues from a probate standpoint, and that's, again, part of the discussion around estate planning. But for now, the big question is that cottage has a deferred capital gain attached to it. So there's some price appreciation. And then you got the home where there's no tax issues. Now, we do have in this balance sheet the life insurance. So life insurance can be a very important way of creating some liquidity that goes into the estate on death, either in the first to die or second die. Many people will put in place what are called second to die or last to die permanent insurance policies. It could be term to 100, it could be permanent whole life. And the reason they do that is they want tax-free dollars to go into the estate to be at the ready to pay the tax costs. And the cost of the insurance often will be far less than the cost of the tax liability. Okay, let's just stop there for a minute. This is a really good example of the family sort of being on the same side of the song sheet, so to speak, on this planning. So when you think about the family that went through this unfortunate circumstance, had they sought professional advice, it would have been identified that there was an unrealized capital gain that was pretty significant. And the solution that had to be activated to deal with the taxes was cashing these RRSP investments. But that didn't have to happen. So let's assume that the mom and dad were insurable. There's a potential they could have put in place a last to die insurance policy that would have been far more cost effective than cashing in all those other investments to pay the tax bill. It could have been a supplement to the estate. The tax bill would have had to be paid, but it created a supplement and protected the value of the estate by having insurance in place. We've even had situations where clients do that, but they don't feel they're in a financial position to really, pay for the insurance. So you actually see the families basically subsidizing the cost of insurance for mom and dad. A good example is cottages. There's a lot of emotional attachment to a cottage. There's family memories, experiences. The families want to perpetuate into the next generation. And so the kids are motivated to pay for the insurance to help subsidize that cost so that tax-free money comes into the estate, pays the tax bills, and that's really important. In some estates, you imagine if there wasn't any RSPs and there's a large tax liability on the cottage, sometimes a cottage that triggers a capital gain has to be sold to pay the taxes. And that forever now, the cottage is no longer in the family circumstances. So insurance is a really important part of the discussion. Where the family is insurable, that discussion should have happened earlier, not later, because as you age, obviously, insurability issues come up, obviously.
I believe they switched their cottage to their primary residence around 2000. I think they bought it in 1980s or something like that.
Yeah.
So even if they had that conversation after 20 years of owning the cottage, once they switched it to their primary residence, it could have alleviated a ton of this. And I think they would have been in their 40s. So not super young, but it still could have been a really good opportunity to throw some life insurance in there to protect that liability.
It would have been pretty economical at that point, had it been, red flagged at that time. So that's the balance sheet. Keep it up to date. It triggers conversations. I give the example where maybe a family conversation could be very helpful in terms of dealing with the tax liabilities. Now, on this side, we've got Appendix 2, and all we're doing is calculating the potential tax liability. So you can see the source of tax liability on this particular column. What are the sources? Well, we've got deregistration of retirement assets, RRSP accounts, RIF accounts, deemed disposition of the non-registered assets. Okay, so that's money that might be in stocks or mutual funds or ETFs that have appreciated in value, and there's an unrealized capital gain. And then deemed disposition of a lifestyle asset, excluding your principal residence. Again, the cottage. So in this example, and this is pretty typical of the work that we do, we're going to go, well, if something happened to both of you today, there'd be a $330,000 of income from the RSP accounts. That's treated as income in the year of death tax filing in the last to die. At the time we did the calculations back a number of years ago, it was a 46, basically almost a 50% tax hit. So that $330,000 triggered a $153,000 tax bill. The deemed disposition of non-registered assets, well, the market value of those accounts was $551,500. There's a cost base of $463. Only 50% of the gain is taxable. So at that rate, the tax cost was $20,000, just over $20,000, $20,416. And then the final piece, the deemed disposition of the cottage property, $350 market value, $225,000 cost base, and then the tax bill about $29,000. So estimated income taxes payable, $202,000. Now, again, this family has permanent insurance that will also be triggered into the estate, so they wouldn't necessarily have to erode financial assets or real estate assets to pay the tax bill. So this is the kind of exercise, when you look at the different advisors that can play a role in these decisions, an accountant does a really good job of doing a tax performance statement based on your current circumstances right now, right? Your financial planner can do the same thing. The lawyer can help establish maybe mechanisms in your estate planning to maybe be a little more proactive. Sometimes even trust can play a role. So maybe you have an asset that's growing in value and you want to freeze the value of the estate. Maybe you transfer some assets to a trust and move that price appreciation onto somebody else's balance sheet, or maybe even gift assets proactively. So the lawyer can help find out and determine which mechanisms are most efficient, and making sure that in writing it's clear, there's no ambiguity, the family knows what the intentions are. And then what a financial plan will do is it'll give you a representation based on the assumptions as to what your estate will look like in every year of the analysis out to life expectancy. And we'll also calculate what the potential tax liabilities are. And that's a very helpful exercise to go through, again, to be a little bit proactive, create some conversations for families. There's lots of strategies that can be initiated. This, again, was a very unfortunate one. And back when they were first making these changes, one of the ways you can deal with this last to die situation happening very quickly in a short period of time is, like I said, insurance can play a very important role. The other issue is we often talk to clients about proactively getting money out of tax deferred accounts or proactively triggering some capital gains along the way. So it can make sense for non-registered portfolios, and many times clients are reluctant to do this. So I don't want to pay tax. A dollar of tax deferred is a dollar gained. That's what your accountant will tell you. But peeling off some gains and some taxable income regularly to reduce over time the tax deferred liability on the estate can be a very, very good strategy. So when we do the SNAP projections, we can kind of quantify for the client, okay, deregistering paying tax early, what does it do in terms of eroding your after-tax income potential through your retirement years? Because it could be a cost. If you're absorbing tax early to reduce estate tax, what does that do in terms of your income producing ability? So sometimes the two are in conflict, but you want to see that I'm going to erode, I'm going to basically deaccumulate more quickly on my portfolio that has taxation, pay some tax, but I want to try to reduce that tax bomb down the road. And what does that ripple effect have on my retirement income? And a lot of times clients will look at that and go, well, my retirement income might be a little bit lower because I'm paying tax early, but that tax bomb is greatly reduced. So again, it all comes back to the planning.
Really good. One of the topics they talked about a lot, the idea of, or the concept of qualified beneficiaries. I think the tax liability really hinges on the deceased, who they designate as qualified beneficiaries, whether or not they have any qualified beneficiaries left. And I think that's a really common question that people have. What counts as a qualified beneficiary?
Yeah. So obviously, if you're married, have a common law spouse, then they would be a qualified beneficiary. So you will take maximum advantage of the rollover provisions and not have any tax triggered upon a first to die. Now, the second to die scenario, there's not a lot of circumstances where there'd be another qualified beneficiary you could think of where there's no surviving partner or spouse. There are two examples, though. So if there are dependent under the age of 18, as an example, there is a provision to defer tax. So there are some mechanisms where you can do that, and it provides some level of relief. Obviously, in this situation, given that we're adult children, that doesn't apply. If there are beneficiaries, potentially, kids, as an example, who would be either physically or cognitively dependent past the age of 18, there are provisions to defer that tax and roll it over on a tax deferred basis. So those are two circumstances where you might be able to find a way of deferring that tax bomb. Obviously, as a percentage of the population, that's not super common. And again, if you're in a situation where you might have family members that might fit those criteria, that's where making sure your financial planner and your lawyer are involved in those discussions and setting up structures to make sure that you're maximizing the opportunity to defer tax.
All right, so that's really good. So life insurance, proper designations. What are some other final comments you have for people watching?
Yeah, I think the big one is just be proactive. an engaged conversation with the family where it makes sense. And not all families can do that, but if they can, that's awesome. If you can get people on the same side of the song sheet and plan proactively, that's probably the biggest takeaway. And, again, seeking professional advice is, I think, always valuable. There's links in our show notes if you want to find out more about what we do. We do this kind of planning all the time. So don't hesitate to reach out if you want to have a conversation on proactive retirement and estate planning.
If you're watching this video, you got some positive and useful information out of it, make sure you like and hit that subscribe button. It really helps out. Like Shaun said, if you want to go to our description, go to our website and schedule a 30-minute free complimentary call with us. We'd love to chat and see if we can provide some planning assistance. With that said, thanks for watching. Take care.